It's the 2018 trading year officially. It is January 1st. My trading will begin on January 2nd. From that day forward, I will be streaming live every day in the activetraders.chat chat room. You'll get a link there and you'll be able to watch my monitor as I trade. I talk about the setups and all of that. So that's something that's available to active traders members. Okay, so who am I? My name is Del the Trader. I am a trader at activetraders.chat. I started my trading career 7 years ago now, and it's been a hell of a ride. My background is in nothing to do with finance, nothing to do with anything like that. My background is actually in product design, development, and the world of agencies and all of that. But I have always been a very avid investor. I've always managed my money myself ever since I was in high school years ago. Hey, Olaf, thanks for joining. I'll copy down that question and we'll get to it at the end of the webinar. Should copy your name too so I know who said it. Olaf. So years ago, back in 2007, I began investing in gold and hard assets because I realized that my account was getting destroyed by the 2008 crash in the mutual funds. And I specifically remember a phone call with a bank manager when I asked him, is this going to be, or do you think this is going to be a big market crash in 2007? I asked him. Obviously, 2008, the biggest U.S. stock market crashes in history. And he said that this thing happens every 7 years. Don't worry. Invest in these mutual funds. People ended up losing 30 to 60% of their accounts. I decided at that moment that I wouldn't ever let anybody else manage my money, that I'd do it myself. And if I was going to buy mutual funds, I'd be doing it myself. I wouldn't be using some manager at the bank. The reason for that is not because I have hate towards the banks or anything like that, but it's because, as I'm going to show you in a slide ahead, it pays off to invest yourself and realize using compounding interest on your own account. So we'll talk about that. So that's who I am. My name is Del Trader. I've been trading stocks and futures and Forex, and I've traded everything under the board for about 7 years. I've settled on stocks. It has the most volatility, the most action, and you can make the most amount of money in the least amount of time. And that is the reason why I became a trader, to sort of take my own, take my life into my own hands. So that's my trading desk. This is where I'm sitting right now. It's changed a little bit. I've added a screen on the left side. But for the most part, this is where I live in Toronto, Canada. And I trade every single day, full-time active day trader. I quit my job, I think it was about 4 years ago now. And ever since then, I have prospered. There's been a couple of really hard years. But it's really paid off in the end for me. So now I managed to buy a house in one of the hottest markets in Toronto, in the world actually, here in Toronto. As if you've read the news at all about how crazy the home market is right now in Canada and Toronto, especially in Vancouver. It's only because of trading that I was able to actually purchase a home for my wife and our future family. So taking control of your life is what this is all about. So let's talk about becoming a day trader or trading for a living. Number one, it's a very, very, very big decision. It's an enormous decision. It's probably the biggest decision you're going to make. Now, for me, it's only because my wife was actually working a full-time job and that she was able to support me and tell me, you know what, this is your thing. You love doing this. go ahead and do it full time, that I had some leeway there to actually go full time and become a trader. But for many years, I did trade part time, and that sort of part time trading taught me to have focus. Because the worst thing in the world for a trader is to have all the time in the world and overtrade every single day with no focus. But having 2 hours in the morning, from when I woke up 6:30, started trading at 7 to 9 p.m. on the futures market, trading crude oil and gold futures. I only had 2 hours, maybe about 30 minutes of really good volatility to capture what I needed to capture before I had to go off to work. And that sort of tight environment forces you to create a strategy, create a plan, and try to stick to it to try and make money, not lose money, and then go to work in a good mood, get what you need to get done, come back, and then study trading. All the while building up that trader's confidence to go full time. So, number one, it's a big decision. There's a big impact on your quality of life if you do decide to become a trader. I'd say it's probably that one decision that can have either positive or negative impact on you from top down. So impact on quality of life is enormous. And then just one more point: personality. It needs to match your personality. Not everyone is um, not everyone is set or willing to become a trader when they realize the amount of risk that's involved and the amount of patience and perseverance that something like this does take. And that is the main reason why the majority of traders will lose money. Not because they were trading the wrong strategy or using the wrong indicator, or because you're not some big bank and you can't make money in the stock market. That's what they'll tell you your entire life. When you say that you want to take control of your own finances, they'll say, "Don't do that. You give me your money, and I'm going to make money for you because I went to school. I have a degree in this and that." And the truth is, all it takes is perseverance, patience, and consistency. And if you can achieve those three things, then I don't care if you use a moving average or whatever indicator you might have fallen on, or if you use a more advanced strategy like we do to take full control of the market, you are going to be making money. It's just how long are you going to be making money for, and how much money are you going to be making? So that all reflects your personality. You'll find people on Twitter that made, I'm not going to name any names, but made $130,000 this year, but also had a day where they lost $75,000. And that is an enormous impact on everything emotional, your entire life. It's an impact on your future, your wealth. So I'm not saying that if you're not all personalities can become traders, because I'm sure you can. I mean, the human brain is incredible, and you're capable of almost anything. But you have to know what it is before going in. I'm not trying to scare you. I'm just telling you that that's sort of the level of confidence that you need. Okay, so this is the reason why I became a trader, because, and it's something that stuck with me ever since I was I don't know, a grade 7 or grade 6 student, and we had this really uh, profitable, really successful real estate broker and real estate agent come in. He was popular around our town, and he basically told us one thing that really stuck in my mind, and it's probably the reason why I became a trader. That no one will ever pay you more than they make. And when you think about that, it's really funny because getting a job and looking for those promotions and working on somebody else's project, feeling like you're part of a team, all of that, people saying that they have a great job, it's fantastic if you're looking for a place to settle down and consistently make money. But if you're the type of person that always wants more, always wants to be making more money, then this quote right here is something that will stick with you. And it's something that I didn't ever think about or realize until I did get that job, cleaning tables, and that was really had an sort of a deep impact on me because I knew and when I looked at my boss, roll up in his really nice car, and all of that, that I would never, ever, 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 ever make more money than he did if I continued on that path. Um, so that's the reason why I personally became a trader. Now, I am talking a lot about money, and it sounds a little vain, but I only talk about money in this way because I have a deep respect for money. I'm not scared of talking about money. Growing up, it's always been, hey, maybe you shouldn't be talking about to people about money or how much money you make and all of that stuff. And I wrote a really good article on Medium, but um, it's a very key point because, and this is it right here. It's called "Money: The Elephant in the Room." I wrote it a while back, but the point being that having a deep respect for money in a society where no one is supposed to be talking about money because it's not polite, and then also a society that completely disconnects money from the reality, which is that money is not something that you want because intrinsically it has value. Money is something that you need in order to break free from the constraints of your current life. So your problems are solved much more easily, some problems, when you have that money, because money will equal time, it will equal freedom, it equal flexibility. You can go where you want, when you want. It's basically FU money. That's what I'm talking about. The FU money. I'm not really talking about the money that comes in, on a monthly basis to pay your bills. Yeah, that's fantastic. That's stuff that we need to have respect for that. You don't really talk to friends about that because you don't want to alienate people if you have a lot, and you don't want to feel like you're less than because you have less. What I'm talking about is getting enough to break yourself free from having to worry about other people controlling your life in any way. And that control is now in your hands once, and in the IRS's hands if you're in the U.S., or the CRA's hand if you're in Canada. But it's between you and the government at that point. The middleman, the boss, the people that tell you need to be in on time. You're only allowed taking 2 weeks of vacation, maybe 1 week, that type of thing. You're on probation. You're fired. That type of stuff. That is now in your hands. So the FU money is what I'm talking about. Okay. So let's talk about that the reason for taking control of your own money, your own investment. So it's 2018. It's the beginning of the year. People are looking for new investments. People have exited their old investments. And if you've talked to your local bank manager, um, the bank manager's probably told you, hey, we've got some really cheap bonds right now. Mutual funds are doing really well. But the big problem with giving your money to a bank or an institution to invest is that is the compounding interest. So, who sets the compounding interest? Now, I'm not going to go over exactly what I'm sure you guys already know about compounding interest versus simple interest. But just on a very basic level, simple interest is a set percentage growth per year, right? Versus compounding interest, which is an increasing percentage of growth per year that will exponentially increase faster than simple interest. And so let's imagine the blue line down here, which is the simple interest. Let's imagine that is you working at your current job. So you work at your current job right now, and you know that by the end of the year, you're going to be making X amount of dollars per year minus taxes. And you know that if you save up enough, after you've paid your bills and all that type of thing, you're also going to be making, that much more the next year. You might get a raise, if you're lucky. But the increase or the increments that price is actually going up here, that your income is going up, is set by not you. You are not in control when you're working that 9 to 5 job or when you give that money to the bank. Um, the people that are setting this increase here, this line that's going up, or the rate of increase, is your boss, how much you're supposed to be paid for your current position. These are ceilings. These are ceilings that are automatically set when you take a position at a job. And then at the bank, your percentage increase on your, say, savings account, which is stagnant. It is stale. It is simple interest. It is not compounding interest. Um, and then the red line here is what can happen if you apply all of the restraints and rules and all of the everything you're going to learn in your trading career to another investment account where you control the rate of growth. Why? Because you can control the rate of risk. And that is the big difference there between people that are rich and people that are poor. I'm not saying rich and poor as in good and bad. I'm just saying it's control versus no control. When you take debt, when you take credit card debt, when you take any type of debt, mortgage debt, which in French, mortgage, French word for uh, death pledge. When you take on debt, you are giving up control of your own compounding interest. That FU money is that much further away. So, compounding versus simple interest. Compounding, you are a trader. And I don't care if you don't actually trade stocks, or if you don't trade the stock market at all. If you manage your own investments, you are a trader, because traders take control of their own compounding interest. They take control of how much money they want to grow, how much fast they want it to grow, because they control their own risk. And simple interest, you are not a trader. At simple interest, you are allowing other people to control how much money you are going to be making and that rate of growth, whether it's at your job, through your financial institutions, giving up the control. Okay. Hope all that stuff's clear. I don't mean to be rambling. Sometimes I can go off. But let's talk about people that have an intrinsic debt. That debt basically from the beginning of their careers. You go to school, you get a job. They tell you, what do you want to be when you grow up? And then finally you make it into college or university. And right now, this cartoon shows exactly what's happening all over America and Canada, all over the world, really. Anywhere that has large educational institutions and people looking for jobs. Thereafter, people have 5-figure student loan debts. They have massive debts because you're paying somebody in order to get a job. But it's not a one-to-one transaction, because there's no guarantee that you are going to get a job after school. So, I went to college. I think it's a great place to learn how to learn, but they are not going to teach you how to take control of your own future. They are only going to teach you how to fit into a mold that somebody may or may not need in the future. So my wife, for example, and good thing she's not here, because she would kill me if I told her I was talking about this with you. But when I met her, she had quite a bit of debt. And I managed to pay off her debt for her. And I'm okay with that, because that's fine by me. I'd rather her be debt free and take control of that interest that she's being charged on her loans. And that is being able to free somebody from chains. Somebody you love, being able to free them from chains. Your kids not having to worry about this debt, because you'll pay it for them when they want to go to college. That type of thing is power over your own life, right? And over your family's lives. So I just want to read this. These are the parents on the left. They said, moving back home, kids today are so lazy and irresponsible. Your mother and I started out with nothing. And there's the kid, and he's carrying all his loans. Trust me, I would have loved starting out with nothing. And yeah, so that's sort of the reasons why I became a trader, and I'm very passionate about becoming a trader. Tommy says school teaches skills for company employees, not how to own your own business. Exactly. So it's it's a good place if you want to learn how to become a doctor, something that requires a level of learning that you can't get on your own. You know, if you want to be a really good doctor, you're not going to go off and learn it all yourself and then expect to get a job because of like safety and all that type of thing. But for the most part, if your goal is to um, get that FU money and take control of your life as fast as possible, you're not looking to become a doctor anyway. Um, so, anyway, all right. So that brings us to this goal. What is the goal for us of becoming a trader? So the goal is to trade 3 hours a day. So that's maximum. That is maximum, maximum, maximum. A lot of the time, I will be trading, 30 minutes, making all the money I need to, and the rest of the time I'm watching, I'm learning, I'm talking about the entries, and unless I see that gold setup, I'm not trading anymore. But the goal is to trade 3 hours a day maximum, practice proper risk management, and build a steady compounding income. Not that quick rich, get rich quick in one day type thing, but to create wealth and take control. Need to clear the throat. So not to get rich, but create wealth, and that is something that like a lot of people don't understand the difference of being rich and being wealthy. So if we were to give, and I think I'm probably, you know what, I'm going to go out on the streets of Toronto, and it'd be really funny, really fun skit to add to the channel. But I'll go out on the streets of Toronto, and I will give people two options. Do you want to be rich or do you want to be wealthy? Um, and I can tell you the majority of people, the reasons they would probably just want to get rich. Everyone wants to win the lottery, but getting wealthy requires um, a level of knowledge of investment, because once you do have money, the hardest, or something that people don't think about or realize, is that the hardest thing is now keeping that money and keeping other people's hands off that money, not just getting a whole bunch of money and then living off of that, throwing in a checking account. Everything becomes an investment at that point. So being wealthy is having the power to make your own decisions in your own life. Um, it has the it's being having the ability to be able to invest in things that are going to grow over a period of time in the future. You have power over your own compounding income because you've taught yourself. So wealth is something that you earn, and getting rich is something that you're given. And so applying compounding income to this whole sentence here, this whole paragraph, is super important. And so if I could underline compounding income, that's really the piece, and that's why we've become traders. Okay, so why trade stocks? And this is a question that I get a lot, because on the internet you will find that people flock to the areas of investment um, instruments and opportunities where the most amount of advertising dollars are. So, number one advertiser for investing online for the quick rich schemes and all that type of stuff, everything you'll find online. The number one is Forex trading. And it's just because of the structure of Forex. So Forex is international. There's all sorts of laws that have not been written in tons of countries about what you can and can't promise people when it comes to investing. And the commissions, the affiliate programs, all this stuff equals big money for advertisers that can fool you into throwing $1,000 into a forex trading account. That's foreign currency trading, forex pairs, and all that type of stuff, and have you lose that money. The more trades you make, the more money the broker makes. The more links you click, the more money the advertiser makes. And the longer you stay in losing money, the more money some of those advertisers will make as well. So we see people funneling towards forex, and that's where I started. I started in forex trading because it was really cheap to get into. I saw a whole bunch of moving charts that I could just buy and really think that I could make a lot of money. Very quickly, I realized that what's missing from the forex market, unless you're a long-term investor and you're using fundamentals to trade on the forex market, what's missing from the forex market is really the ability to analyze the market participants, the volume, the order flow. You don't have the ability to analyze those in this market, so you're trading blindly. However, forex trading is really good if you're doing long-term, multi-year, multi-month investments in a currency because you think that the US dollar is going to strengthen against, say, the Aussie dollar for whatever reason. So it's a good investment vehicle for long-term trading. So that's Forex. And next we have futures. So futures is a lot simpler, and it does have the ability for you to look at the market participants. It does have the ability for you to have the liquidity and the volume necessary in order to trade every day if you wanted to. It does have the movements necessary for you to take money out of the market. However, the big problem with trading futures is the amount or the number of instruments. So there's only maybe a handful of instruments that you'd be able to trade from your whatever country you're in. You're trading for the most part, crude oil or gold or things that are really moving, or maybe the 6E, the euro, and these are derivative contracts basically of currencies. And there's a handful, maybe 3 or 4, that you would want to trade every day. And the problem with trading only 3 or 4 is that everyone else is trading 3 or 4. And we live in a world where an enormous percentage of bots, of high frequency trading happens inside of the futures market because the liquidity is there and there's always action. So this is a picture here of the stock market versus the futures market. Now, if you are a high frequency trading machine and you want to take advantage of a, say, gold contract or an oil contract that is trading right now in the futures market, say it's trading in the futures market, you've set up your servers here to be as close as possible to the CME, the databases, whatever it is, and you've set up your orders here to be first in line, just with speed, and maybe you're taking a cut off of the bid-ask spread, that type of thing. All of these strategies that are used by high-frequency trading machines, these bots, are applied easily applied to the futures market. And there's no way for you as an individual trader to get away from from what the algos and the bots are looking for, which is high liquidity, high a certain price level, and the levels or the volume that's necessary in order to get in and out of the market, 1,000 times in a minute. That type of liquidity is available in those maybe 4 or 5 instruments that you're trading in the futures market. And so that's the long way around of saying that when you trade futures, you're trading futures alongside all the institutionals, all of the algorithms, the high frequency traders, the smart money, and the dumb money. And what's happening is the smart money is basically, or the big money, and the bots are basically taking advantage of people that buy market or sell market on the futures market. So it's a losing game in my experience. Um, and you can make money in the futures, and there's a lot of people that do make money in futures. But I think the probability is much, much higher when you're able to filter out, like for example, in stocks where there's thousands of stocks that you can trade, and you're going to find those 5 stocks that are low float, that have just enough, have a lot of volatility, but just enough volume to make you feel comfortable in getting in. You know it's going to move, and algos will stay away from these because they can't jump in and out thousands of times in a minute. The liquidity is probably not there for them. So you're able to circumvent a lot of these algorithms and the 75% plus of volume that's created by algorithms in the market right now, by sticking to stocks that are mainly populated by retail investors and maybe some institutional investors. I hope that made sense. But this picture here is the stock market versus the futures market. And this is the complexity. So the amount of middlemen and the amount of setup it takes, and the accounts and the brokers and the SEC and the fees and all of that stuff, just in order to get a trade going, it's much more complex than the futures market. And initially, I thought this was a bad thing, and this was the reason why I should be trading futures. But later on, I did realize that this complexity actually can work for us, for the reasons that I outlined. Okay, so that's why I've settled on stocks. So stocks, they move a lot quicker. They have much better returns in a faster period of time at the open, and the range is just much larger on these low float stocks that we trade than any futures contract will ever be. Okay, so we are on to trading psychology, something that I want to linger on for a little bit as well. Do you guys have any questions about the previous slides, or anything else? If you do, just drop it in the chat, and I'll address it. Okay, so trading psychology. Now, this is organizing. This is like organizing an entire room of loose papers and, a lot of throwaway items that you didn't find a trash can for. Imagine the messiest room that you've ever seen, and over the course of 6 or 7 years, you're taking all of this and you're putting you're digging through all the pieces of paper that are most important and throwing it into a bucket, and that bucket is called trading psychology. And that's a challenge that you'll have when you do decide to become a trader, especially at the beginning of the year. You should be concentrating on that psychology and not so much how much money you're going to make per day trading or anything like that. You really need to be focusing on trading psychology, because going in with the wrong psychology at the beginning of a year will equal a possible disaster for you. So one of the big lessons that I learned about trading psychology is that it is my biggest enemy, and I've always heard that everywhere, but it didn't really sink in until I started tracking my trades, and then in one year, I should say in about 3 months when I lost about $10,000 trading small size. That means a lot of losses. Um, it's not like one bad loss. It's just a lot of really bad losses because I started um, in the wrong mindset. So this is sort of the goal for your trading psychology. Um, you want the psychology of being an emotional person. You want the psychology um, of your entire past when it comes to anything emotional to take a back seat to what really needs to happen in your mind. Is you will find that there's that 1 month or that 1 week or even that one day, and if you're lucky you'll realize it in really early as opposed to much later, and this is something that you will not be able to control. But there's a switch that'll go off in your head after you've beat yourself up, you've questioned yourself a million times, you've said, you know what, I'm continuing to lose money, I'm not learning anything. But you can lose money consistently and still move forward in your trading psychology, and that's the toughest thing ever. And that switch, when it goes, you will become an operator of your own trading strategy. That's the mind switch that happens. That's the aha moment. And maybe it's learning about something and changing your mindset about something, but becoming that operator is the click. Because once you become that operator, you are now operating off of a set of rules. You're operating, whether they're hard rules or soft rules, you are operating. And when you become an operator, you're able to analyze things better. You're able to remove the emotion necessary to become a profitable trader, and you're able to analyze. So this was a trade from earlier in the month. Um, it was DDD, and I was really happy with this trade. And it's not because I didn't actually make that much money on the trade. And that's what being an operator will do is you'll be able to identify. So I'll walk you through the trade and I'll tell you why it's so exciting. But really, I bought this. I think the average price was around the HVN at $9.34, and it ran up. And overall, I had a plus in of 59 cents on the whole trade, and that's not a lot per for a trade. But the reason why I highlighted it is because of the execution that I had on this trade, and the way that it was executed, and the mindset, and everything kind of clicked together to give us this trade that was actually in the live room. And so I'll walk you through and I'll show you why it was so exciting for me. And even if I lost money at the end on this trade, I mean, I followed my rules so I wouldn't lose money. Um, but even if I'd made close to zero, or if price spiked all the way back down for whatever reason, maybe some negative news event, and took me out of the trade, I still would have posted this, because I was an operator when I took this trade. And if you can look back at the trades that you've taken and say I was an operator on this trade, and these are the things that I did in order for this to position myself properly for taking risk on this trade, then the outcome of that trade does not matter. Because if you do that 100 times, 1,000 times, 10,000 times over your trading career, you will be profitable 100%. So, trade started off, normal open, price going a little nuts, spiking up in the morning, trying to squeeze out some of those sellers. And then price reversed and had this big dump. And as soon as that big dump happened, this big emotional dump, um, it went onto my radar right away. And I knew that I had to pay attention to this stock, whatever might happen. So sellers came in, took control, lost control around 880s. and then price moved up higher in a consolidation pattern, and then price moved back lower in a consolidation pattern, and we had on our hands what they call the expansion and the consolidation. The consolidation was broken off into many zones, as you can see, but for the most part, inside of this move, we could see that the volume was beginning to increase. The buying volume was beginning to increase after that big sell-off. We could see that there was buyers beginning to take positions, beginning to accumulate their shares as price was coming up, holding key levels of resistance, creating trend lines, creating ascending trend lines. And that to me tells me that this spike down was now a failure for the sellers, and that they were being pushed further and further and closer to the edge. So, following my rules, I saw that this was happening, and on my specifically set confirmations with volume coming in, with the proper range coming in, and the consolidation, I began into a position, adding into the position, into the break, paying myself into the first wash, paying myself into the first top, and then adding to the position once we saw that same pattern once again take shape, and really just compounding my return. My initial investment was down here, but because I was in control of the ability to compound into a position, I compounded the number of shares that I had to compound my returns, and I added in when I wanted to add in when I saw that the rules were being met, and I managed to ride the position all the way to the very top of the move. So I love this trade, and it's something that I will look at over and over and over again, and I will try and remember the exact mindset and decisions that I had when I made the right decisions in this trade. Not so much the amount of money that I made on the trade, which is why in the room I never talk about the amount of money you make, because once you start talking about the amount of money you make, the amount or the percentage of the move that you've captured, which is what's really important here. Oh, sorry. The percentage of the move that you've captured takes a back seat. So right now, this in this trade was the maximum that I could have captured on the trade, and this here, and I draw it with a triangle because my stop moves along with the trend line as price goes up, so my stop gets better and better, my risk gets lower and lower, and I captured basically 99.9% of the range of that move. And other traders on YouTube and streamers, they won't talk about the percentage of the move that they captured. They'll only talk about the amount of money that they made. So if I switch over to the pen, if I threw in like 20,000 shares here, let's say, and price jumped up a little bit, and then I sold everything here, then I could have made a ton of money, and I could have posted a nice big fat P&L in the channel or on Twitter, and everyone would have been like, ooh, ah. But what's more important is that as a trader, I only captured this much of the move when I could have captured this much of the move. Understand? So always think about it in how much of the move you're capturing when you're in a trade. So that's one of the points that I just wanted to go over. Beginning of the year, always want to continue thinking about that as we go. Okay, so let's talk about risk versus reward. Now, the absolute beauty of becoming a trader is in this chart right here. So, we talked about taking control of your own investment, your compounding interest, all of that type of thing. So, if you think about every trade as a percentage of your account, so if I have $10,000 in my account, I want to risk, let's say, per trade, I don't know, like 1% or 2% of my account per trade. If that's I don't know why I drew that sideways. If that's my risk, then what I'm looking to do on the flip side is I'm looking to make at least 2% on that trade. Why? Because if I make 1% on a trade and I risk 2%, if I get a loser and I only made 1% on that trade, then I lose 2 times the trade. Does that make sense? That's something they call R value. And I don't really want to get into R value because I think the way they've laid it out is kind of confusing. But I'll talk about it deeper in another webinar. But the whole point is that you want to make at least 2 times what you've risked, so that if you lose the next time, you have another opportunity to get it right in order before you're in the red. And that's the only thing that should be on your mind is how much you're willing to risk versus how much you're willing to pay yourself in reward. So this chart here shows the win ratio on the left side. So how, out of, let's say, 1,000 trades, this is the percentage of wins. So you can see there's even all the way to 90% of wins, or down at 10% of wins, and that's only 10% of the trades you've taken in that out of that 1,000 trades have been winners, versus 90% of those trades have been winners. And if you can do this, please just send me an email and tell me your secrets. But for the most part, the majority of traders will be stuck inside of this range right here. The majority of traders are stuck within 30% to 50%. And that 90% of traders lose money, and that whole argument there about why you shouldn't become a trader is people that are stuck inside of this box and don't know how to get out. Now, something that you won't hear a lot about is what happens if you introduce proper risk reward management to that box there. The majority of traders, let's say 90% of traders, are inside of here, and you guys are probably in there as well, some of you, and it's totally fine. That's a normal place to be, because you don't have any crazy insight into the market. You're not like a 40-year trader, so you're stuck inside this box. This is where you learn. And sometimes you'll dive down into this area, which is really sucks, and I'm sorry if that happens to you, but I think you'd learn faster if that happened to you and you were consistent. But if we introduce risk reward into each one of these trades, where I start making 2 times my money every time I risk, let's say 1 or 2%, then eventually what's going to happen is, over a longer period of time, over a larger sample of trades, I am going to start becoming profitable. And the profitability line for that 2 to 1, and some traders, they take 3 to 1 or 4 to 1, and it's much better and much easier for them. But let's take 2 to 1 because that's reasonable for most people. If you start trading 2 to 1 or making 2 to 1 on your money, then the line for you to become profitable becomes 35%. So that means that you can be right only 35% of the time, and because you've practiced proper risk management and you have a proper risk reward ratio that you're applying to your trades, you could be making money. So that is something that I didn't understand for a long time, and I didn't really have it explained to me for a long time. I thought you had to be right more than 50% of the time. I thought that's what it was. If you're wrong more than half of the time, you're losing money, and if you're right more than half of the time, you're making money. But that's only for the 1-to-1. That's only if you risk $100 and you pay yourself $100 every time you win, and you lose $100 every time you win. That's the coin flip, right? This is the coin flip. But we're not doing a coin flip. We're professional traders. We want to be profitable. We want to take control of our money. We want to get that FU money. We want to leave our jobs and we want to buy homes for our wives. And we want to pay schooling for our children. It's much more important to manage this risk than it is to worry about the win ratio, because we're in it for the long term. Just like a casino, has maybe a 3 or 4% advantage over the players. They know that they probably only have to be right about 35% of the time. So the 2-to-1, let's say, you are making money. Okay, so I hope everybody understood that. I will go deeper with live examples, and we'll have a whole. I've got it all planned out here in the outline, but this is Cole's notes for a lot of the key areas here. Now that we're starting the year, just to get your minds going. So go out, do your own research. Make your own Excel sheets and calculate how much money you'd need to, or how many times you need to be right in order to start making money. 35% is what you'll find with a 2-to-1 risk-reward ratio. And what I trade is at least 3-to-1. That's what I trade, is at least 3-to-1 on trades for the most part. And if you've watched me trade live, you'll see that I'll take a lot of tiny losers. Tiny losers. But when I win, I'm making 16, 17 times my risk. And Tommy there in the chat room will, I'm sure, vouch for that. So, super important slide. Super important slide. Take a screenshot, whatever it takes. Okay, great. Let's get rid of this mess. Anybody have any questions about risk-reward management? There will be another webinar, but if you have any quick questions, I can answer them. Okay, so managing risk is vastly more important than picking the top or the bottom. And that's really the TLDR headline. I had this on my wallpaper on my computer for two years, and that's what I saw every day in the morning when I booted up, was ready to go, getting prepared. That managing risk is more important than picking the top or the bottom, and it's vastly more important because of the reasons that I just outlined. If you're picking tops and bottoms and you're thinking, the stock's going to turn around right now, you don't have a set of rules. And if you don't have a set of rules, you can't manage your risk properly. And if you can't manage your risk properly, you don't know how much you're going to lose. You could lose all of your money, or you could make a lot of money, but it won't be consistent enough for you to build a lifestyle around, for you to be able to quit that job, for you to be able to take control of that compounding return. So just a few words about our trading methodology. This is not going to be a deep dive into our trading methodology. But if you're new to activetraders.chat, if you're new to my channel, I do have videos that talk about this methodology, and this is going to be part of the course. But the trading methodology that we use at activetraders.chat is the greatest weapon, because and like I said, you can be profitable just by trading moving averages if you apply proper risk reward management. It doesn't really matter. But if you want that FU money, and if you want to become wealthy as opposed to being short-term rich here and there, then the path to becoming wealthy is to understand and fully understand the market. So inside of this trading methodology, some of the components are inside of market auction theory, which is the psychology of buyers versus sellers inside of an auction. Order flow analysis, which is the analysis of the orders that are committed and not committed to the market at any given period of time on any instrument. the volume analysis, which is the analysis of commitment of buyers um, in the volume at certain price levels or time periods, and then exploration and discovery, which is I think a beautiful um, a beautiful way of dividing any chart and any market into two main areas, which is consolidation and expansion. So exploration and discovery, consolidation and expansion. And the job, or my job as a trader, has become to be an operator of this strategy, where I look to find this piece right here. What happens when the price exploration turns into price discovery? That right here, right before the discovery, just as the discovery is beginning, that's just before the price expansion is happening, right? So you have a stock chart that's exploring right now. That's the price exploring. Maybe we see an opportunity for price to go from this exploration, which is also known as consolidation, into an expansion phase. That right there, that move right there is what I look for in the discovery. So that is some of the things that you'll learn at activetraders.chat. So for our members at activetraders.chat, I hope this webinar has been helpful in just getting that mind ready for the 2018. I have another webinar coming up shortly that'll be only for members, because we do a deep dive into that exploration discovery. We do a deep dive into some of the more important areas for actually executing your trades and making sure that your risk reward and your risk management is fully secured, and that you're able to separate yourself from that emotional being and really initiate and control the trader mindset. And that's what you want to foster in your mind and grow and feed as much as you can. It'll go hand in hand with the amount of confidence that you have in the market, in the trades. All right, guys. So that's the end of the webinar. It's been about an hour and 9 minutes. So not the shortest, but I think we covered quite a few items. I wish I made a slide that encompassed everything together, but I did not. So once again, my name is Del Trader. You can follow me on YouTube. I post videos there, some recaps and some video live trading. And if you want to become a member at activetraders.chat, we do have a free trial. You won't be billed for 7 days, so you don't have to worry about that. And you will get access to our learning materials, daily live stream as well, our chat room, our activetraders.chat private Slack chat room here. You'll get access to all of that. And obviously, we do have the members webinars. The next one that's coming up is going to be super important, and it'll be instantly applied to the trading day. If you're a brand new trader and you're just learning about trading, there's also going to be materials for you as well. So I'd suggest signing up for a free trial, joining the live room, joining our community, chatting with people, and seeing if trading is something for you. All right. So do we have any other questions here? Relevant to the things that we've talked about would be great, but I'll take any other questions. So we do have one question from Olaf earlier. He's asking, what is the best platform for investing? So that's a very loaded question. Very, very loaded question. Um, I'd say if you want to trade stocks, you're if you want to trade stocks, you're looking at brokers, and the brokers will have platforms for you to execute your trades on. If you're talking about charting, or let me pull up my charts. If you're talking about charting, I just have Ethereum up here. But if you're looking at charting, then I'd say TradingView. There's links in the description. Bookmap is really great. Another really great platform for reading the level 2 on a more advanced level. And yeah, that's really it. I'd say if you want a free version, free charting, there's oh boy, I made a video on it, but there's other platforms you can use. NinjaTrader's a paid one, really hard to use for stocks though, and kind of expensive. You can also use let's see, Thinkorswim. Thinkorswim is fantastic for if you have a little bit of money to throw into a TD account. They'll give you Thinkorswim and live data for free. So suggest looking at that one. But TradingView and my broker's platform is my go-to, my lifeblood. So anyway, guys, thanks a lot for joining here. I hope it was helpful. I hope you learned something. I know this one was a little more centered around the why and the trading psychology, but it's super important to gain that mindset at the beginning of the year. I know our members will appreciate that. And then you can go off onto your trading journey and look for more detailed strategies and things that you can test. But for the most part, this is sort of the basic mindset you're going to need in order to become a successful trader, and really work on that confidence and taking control of that compounding interest, control over the compounding interest, and going for that FU money. All right, guys, Happy New Year 2018, ready to go. Trading day starts tomorrow, 9 a.m. Eastern Time. I'm going to be sharing it in the live room. Head over to activetraders.chat, sign up for a free trial, and you can watch me trade live. And hopefully we'll have a really kick-ass year together. I'll put together some of my percentage gains and profits as well. I'm putting that together. I print it out every single year and drop it on my desk just to remind myself of the things that I need to do correctly. Take a journal as well, guys, and please trade responsibly. Once again, I am not a accredited investor that you can go to for trading advice, so this is merely my opinion. All right, fantastic. Thanks for joining. See you tomorrow in the live room.